Hey guys, today we want to talk all about this disability insurance benefit that our resident and fellows have at the University of Arizona Tucson campus called the Guaranteed Standard Issue Program. So if you're not familiar with it, stay tuned. We'll talk all about the disability insurance program that you have access to and really break down the weeds of the actual policy with you as well. But if this is your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and certified student loan professional, and I'm also the son of two doctors, and I've really developed Lifestyle Creep for you guys and really want to help the healthcare workers in our society to be more intentional in their finances, really simplifying the complex around their finances. So excited to dive into this with you today. So let's talk a little bit about what is a GSI, or Guaranteed Standard Issue Program. But before we get into that, I want to give you a little bit of background on how this started. So as an advisor, we act as a broker for our clients to the variety of the different disability insurance companies that are out there. And so for our clients, we want to make sure that we have what's called true own occupation definitional language. So if you haven't tuned in to one of our other episodes, we have a whole slew of videos talking about what is that definitional language, how it's important. But if we already know that we need that, we know that there's also limited options on the market that you have access to. And so, but typically when you get your disability insurance, you're going to have to go through a traditional underwriting. So underwriting is a fancy word of saying health screening. So they are going to dive into the weeds of your health history and look at any pre-existing conditions, any risky hobbies that you might be in, anything that's going to predispose you to being disabled in the future. They're going to want to know about, right? And so the crazy thing is, so we were doing this at the University of Arizona for a while with residents and fellows, and crazy thing is that 40% is the latest statistics on this. 40% of our residents or fellows, when they go through a traditional health screening or underwriting process, 40% of them are getting either declined outright. They're getting an exclusion put on their policy, meaning like, hey, you had this knee injury from a while back, we're going to cover everything except for that left knee, right? Or maybe you do rock climbing and, hey, we're going to cover everything but rock climbing, right? Which is probably the one thing that you would get disabled doing, right? So all of those things, or they get rated, meaning that they get a more expensive policy. So 40% of our clients were falling into one of those categories, right? So when they're going through a full underwriting or health screening process, there's a lot on the line for these companies, right? Because they're looking at your health history and they're trying to see how predisposed is this person, this one individual, going to be for a disability, and are we going to be on the hook for this for the long haul, right? So with a true own occupation policy, there's a lot on the line for them because there's not a lot of outs for them to not pay the claims on this. And so they're very, very particular on this. And so one of the biggest ones is the mental health, exclusion. So, it's very few and far between that we come across, a medical student or someone who hasn't had some sort of history of, some sort of anxiety or depression or, in treatment for that. And they are so quick to put an exclusion around that these days. And so it's so crazy to see this sort of stuff that we wanted to find an alternative, because there are some clients that we're running into that just had kind of non-starter pre-existing conditions, right, that we wouldn't even want to apply because we knew that it would be a decline. And so what we did is we went to the different companies and said, hey, would any of them take us up on a guaranteed standard issue program, right? And so this means that instead of the company looking at your individual health history, they can look at the university as a whole and say, all right, can we go based off of the law of large numbers to determine the risk as opposed to your specific health history, right? So we went to all the different companies, and one of the companies called Emeritus, which is one of the big 5 companies you've probably heard of. They're one of the ones that have been doing this for quite a long time. And they took us up on it. And they said, hey, if you didn't, get a census from the organization of all the residents and fellows, that's we can explore setting that up. So we worked with your former GME director, Diane Bigelow, back in the day, and she got us a census of all the residents and fellows at the University of Arizona Tucson campus and broke it all down. And so we sent that over to Emeritus, and they took us up on it. And so what we now have access to is that now it's not a formal benefit of the university because we can't, there's a lot of red tape from the administration standpoint, for, what we can and can't do through the hospital or as an official benefit. But we don't even need it to be, right? We just need the insurance company to know how many people are in the resident and fellow population so that they can make their risk determination. So essentially we're just piggybacking on the university, but we're not even an official benefit. So that's why this program is only really by word of mouth. So this is why you're not going to get a bunch of emails from the GME office on this or from your benefits department, because we're simply just piggybacked on the university's size. But it doesn't mean that you don't have this benefit, and the only way to get this benefit is to be a resident or a fellow of the University of Arizona Tucson campus. So let's talk about what this is. So the Guaranteed Standard Issue Program for U of A, so that, like we talked about, there's not an actual formal health screening process. The process is really straightforward. So if you say, you're interested in it, we can run you some quotes and see what the cost is. It's very straightforward. Those do not change. And then you say, if you want to move forward with it, great. We send you the DocuSign application. And then you look at it, you have to answer, I think there's like 4 health questions, and they're very vague and very easy health questions. They're like, are you disabled right now? Or do you have a major medical thing going on right now? Or do you have Alzheimer's right now? They're really, most people are going to be able to check those no. And so even people with major current pre-existing conditions still have been able to check those no, right? So that'd be something that if you do have a pre-existing condition, love to chat with you, because this is for you guys, right? This is the perks of this program. So it's really important that we know about that. So there's no formal health screening. If you can check no to all these kind of basic health questions, that's it. There's only 4 of them. They're very easy. And then you move on, and then you get your policy within 5 to 10 business days thereafter. So there's not a whole drawn out process of underwriting, because most of our clients that go through like a full normal health screening process, it takes several weeks to get your policy, whereas this is super easy because there's no health screening. It's just a guaranteed issue, so you know what you're getting, and then as long as you answer no to those health questions, you get the DocuSign sign, and then it's just a waiting game until they print your policy, and then you sign off that it's enforced. So it's very straightforward. Okay. The other thing is that there's additional discounts. So since they're offering for just the University of Arizona Tucson residents and fellows, most of the companies offer kind of a resident discount of like 10%. They stack on an additional 10% because it's a GSI discount. So it's a really competitive prices across the board. It's tied with, or if not the least expensive option on the market in almost all situations, except for a couple specialties where it's like very close. And so we still like to even look at it side by side, and you can see where they fall in your specific specialty. But usually the benefits of having this and not having to go through a health screening process, even if you don't have any pre-existing conditions, just the time-saving component is worth it, especially since if it's the same or even cheaper of an option for you than others on the market. Okay. And then obviously it's a true own occupation policy. So this is the core of the policy. It's a true own occupation policy. It's not some watered down version of a group policy or anything like that. This is an individual contract that you have with Emeritus, just as if you were to go through and get your own policy elsewhere. It's the same contract. It's just since if you go through this program while you're in residency or fellowship, you get to lock it in at these lower rates, which is huge, and you don't have to go through health screening to get it. So that's awesome. And it's portable, so you can take this wherever you go next. It's not tied to the University of Arizona. Another perk of it not being, an actual benefit of the university. It's not tied to the university. It's between you and Emeritus. It's just, your ability to not have to go through this program is what the benefit is, right? So we don't have to go through a whole health screening process to actually secure it. And then whatever you get, you have options to, increase it down the line. And so we'll do a breakdown later in this video. We'll actually go through an actual contract so you can see some of the benefits. I'll break it down, explain some of this, kind of translate some of the language on this, because I know it can be a lot of times overwhelming for folks to kind of look at these contracts and say, what the heck is it actually saying in here? What is it covering? What is it not? So we'll break that down. But big thing to note is that if we are looking at the GSI program compared to other options on the market, we really got to be careful, because if we go and we have you apply with another company and you do get declined with them, well, now this is off the table for you. You don't have that as an option. Whereas if we go through this first and you get your policy through the GSI, you could always apply after. And if you decline, great. But one of the questions on that application is, have you been declined with another carrier recently? And so that's why it's a very high liability recommendation for us, even when we're acting as the advisor for clients outside of the University of Arizona Tucson campus. We got to make sure that we know who is running the GSI for their university, so that we don't put them in a position where it's potentially we're harming them by applying with another company. And so be cautious before applying with other companies. And that's why why we're trying to get the word out on this, because it is just a word of mouth spreading on this. But it can be really harmful if people don't know about this program and do apply with other carriers and get exclusions or get other declines on the record, because that can make it harder or impossible to get this coverage in the future. So again, so in the next segment, we'll talk a little bit about, like I said, the details. We'll break down some of the language on this, but looking forward to being here as a resource for you. If you have other questions, feel free to reach out. Happy to run a quote for you and meet with our team, talk through any sort of situations that you might be running into, and we'd be more than happy to come alongside you. So looking forward to the opportunity to meet you, and we'll talk to you soon. Take care. All right, guys. So we have an actual sample policy here that I want to actually walk through with you. So this is with Emeritus. This is the GSI policy that you guys will have access to through this program. And so I just want to kind of help translate some of this stuff, because I know it looks a little scary looking at all the contract language, but I just want to break down some key things that that are important for you to know about with this. Okay. So when we're looking at the the actual thing, with the disability insurance income protection amount, a lot of people don't understand that, it's not necessarily just a direct replacement of your income. You actually pay for however much coverage you want them to cover you or pay you if you can't do your job. So this is a policy. This one has 6,000 of coverage. So 6,000 is the match that you can get access to while you're a resident. And then once you're within striking range, we'd consider that within 6 months of graduating, or you have a contract in hand, we can get you up to 7,500 per month of coverage. Okay, so that's the most that you can get while you're resident or fellow. But then once you're outside of the residency or fellow space, they do that calculation a little bit differently. And so you have the ability to increase these things all the way up to 15,000 per month of coverage. And we'll talk about how to qualify for that in a future in a little bit on the contract here. But it's important to understand, that once you're outside of resident space, this is just obviously most of our clients are not making $6,000 or $7,500 per month right now, and they know that. They know that you're incentivized to become, to finish your training rather than get disabled in training, because you'll make more money that way. And so you guys are actually the only demographic that they allow that to happen. But once you're an attending, that calculus changes a little bit, and so then they look at what are you actually making, and then they subtract out any group coverage that you might have through your employer, even if it's probably not something we want to lean on in the financial plan because of the definitional language probably is not up to par. It's still going to count towards your total coverage amount, and then the remaining amount that they have left is what you'll be able to increase your personal policy to. So a lot of our clients might, even that are making 300 plus $1,000 a year, sometimes because their group policies that they can't even opt out of with their new employers are so heavy. And it's kind of, so a lot of these are, not great policies, but they get in the way. And some of our clients can't even get over 5,000 of coverage when they're an attending, which is kind of crazy. So something to really, consider, looking at how much you get while you're in that, that residency, or starting practice limit phase, because that's a nice captive time that they don't really care however much you're making or how much you're going to have. Everybody gets access to that, which is cool. And then the elimination period, this is kind of, you can translate that into waiting period. This is a time frame that you have to wait after you have a disability before they start paying out. So it's 90 days. So that's why we like our clients to have that 3 to 6 months of an emergency reserve to kind of float you for those first 90 days. But then this would pay out from day 91 all the way to age 65, which is pretty cool. So that's a huge sum that could be really impactful for you and over the long term. But obviously, if you have 6,000 per month of coverage right now, that's not going to be worth the same if you have a 30-year disability here, right, in the future. And so that's why we always want to make sure it has the cost of living adjustment rider on this. So this is a feature that will actually go up with inflation. Once you start collecting benefit from collecting your claim on a disability, then every year thereafter, the benefit that they're paying you will actually go up with inflation that year up to a maximum of 3%. So if inflation is 2% that year, it'll go up by 2% the following year. If it's 6% that year, like we've seen some of these through COVID, it's going to cap you out at 3% growth, right? But this is just to keep par with, so you have the same buying power all the way through throughout a long-term disability, which is really good. But a lot of people think that the policy itself goes up every year, though, with this rider, and that's not true. So it's really important to distinguish that this only starts at the onset of the disability. So once you actually have the disability, then this rider continues going out. But that's why it's really important to make sure that you're keeping your base benefit in alignment with how much you're typically spending on a monthly basis, right? So if you start spending more, we want to make sure that your disability insurance stays on par with that. So, typically we want our clients to have about whatever they're spending, in kind of their base monthly expenses to be covered with a true on occupation policy. But and much above that, obviously could be justified. But this stuff gets expensive, and so we got to remember this is the backup to the plan. This is not the plan itself, right? And so we want to be cognizant of how much we're spending on our insurance, because we might want to use those funds for other things in our plan too. Okay. So just kind of running through some of these other ones. Presumptive total disability. This is a disability if you're considered totally disabled. So if you can't, if you have a total loss of speech, hearing in both ears, sight in both eyes, both feet, they have a list here. If you haven't checked any of those boxes, they're just going to consider you totally disabled, and they'll pay you the full benefit, regardless of even if you could do a part of your job still, right? But so that's a nice deal. Obviously, you have to be under a care of a physician. You can't just self-diagnose yourself as being disabled. Somebody else has got to, prescribe that for you. Can't lie on the applications, obviously. And then these are some of the other features. So in the enhanced plus residual, it's a mouthful here. Residual, just kind of, replace that with partial. This is partial coverage that says that if you can't do a portion of your job because of your disability and you're losing income because of that, they pay proportionate to that. So let's say in this example, you have $6,000 per month of coverage, and you can't do, you have chronic pain that makes you pull back to 50% of your time, working, and now you're making half the money. So what they would do in that situation, this rider would allow them to pay you $3,000 per month, or half of your benefit that you're paying for, right? So that's what that is. You got to have a loss of at least 15% in order to trigger this, but that makes sense, right? Now, the other big one that is called the benefit increase rider. So this is one that allows you to increase your policy in the future. So as long as you're eligible, like we talked about with your new attending income, and you can justify the increase from a financial standpoint, your income, you're making enough, then you can increase this policy up to a total of $15,000 per month of coverage. So that's how much you would be getting tax-free in the event of a disability, right? So it does give you the nice ability to increase this thing in the future as your income and or expenses grow over time, which is awesome. But the reason that this, so the kind of the not the catch to this, but some nuance between this is we used to have a rider that was called the future increase option, and that they came to you every year and they said, hey, do you want to increase it or not? And every year on your anniversary of getting the policy, you'd have the ability to increase it or not, right? But it was a paid option that you had on this contract. But with these new policies that recently came out, we switched over to what's called the benefit increase rider, which still allows you to get the increases that we need all the way up to 15,000 in the future. But it's a free rider, but they make you jump through a little bit more hoops to get the increases. So instead of them coming to you every year and asking if you want to increase it, they're only going to come to you every 3 years. And on the third year, you have to apply and show them how much money you're making at that time. And if you do qualify for an increase at that time, then you have to take at least a percentage of what they're offering you. I think it's usually like 50% of what they offer you, if you want to maintain the ability to increase it past that point. So if you can, great. But a lot of our clients too, you get to the 3-year mark, we're either spending more money and we do want more coverage anyways. And so that increase is not a big deal. Or sometimes, like I said, in some instances, your group policy is getting in the way that we don't even qualify for more coverage at that time, right? So it's kind of a non-issue. So I'd rather have a cheaper policy and jump through a couple of hoops on the increases than have something that you have to pay for all the way through, which is nice. So I feel like it's worth the hassle on that. But you also do get an off anniversary increase, meaning that you can increase your policy outside of the 3 year span, but you have to show at least a 20, I think it's a 20 to 30% increase in your salary in order to, justify getting an increase before the 3 years, or a loss of group disability insurance. So typically, if you have like a job change, that could also trigger that ability to increase your coverage if you want as well. So those are, that's how you have the ability to increase it over time as well, all the way up to the 15,000. But so the last, a couple things here, we have the catastrophic disability rider. So this is one that's huge because this is what this does is if you have a catastrophic disability that is essentially says that you cannot perform two or more of the activities of daily living, which are like eating, toileting, transferring continence, right? You can't do two of those. They consider it a catastrophic disability, and they'll actually pay you an additional sum. And for most of these contracts, it's almost double what you would be getting from just your base benefit. So we usually on these policies for 6,000, we'd have a 6,000 catastrophic rider on here as well. So if you got disabled, couldn't do your job, they would pay you the full 6,000 of base coverage. But then if you can't do two of the activities of daily living, they pay you another additional $6,000 on top of that. So we like that because it's a really cheap way of getting a lot more coverage than increasing this base policy, because we want to match this up with your base monthly expenses. But let's be real. I mean, if you have a catastrophic disability, you're likely going to have more expenses down the line for additional things that you might have to pick up. And so that's what can account, this catastrophic rider can account for that sort of stuff, which is nice. So that's something that we always want to make sure we have on there as well. And then last couple of things, obviously there's some exceptions to your policy. So, I'll just read through these. If there's anything that jumps out at you, obviously it can't be self-inflicted injury. It can't be for if you're on active duty, for the military, and there's loss caused by war. There's some other ones that are critical to look at. The big one that we always get questions on is for normal pregnancies. So this is one that essentially if there's a normal pregnancy or childbirth, what was happening is a lot of women were going out and saying, hey, I'm disabled like 90 days before they deliver. And so that would start their 90-day waiting period. And then once they deliver, they would start getting disability benefit, for that time, because they would have a doctor say that they shouldn't be working, right? And so there was a lot of getting taken advantage of during that true on occupation definitional language. And so they put an exception on there specifically for normal pregnancies. Now, if you have a complication of your pregnancy, which my mom actually had a complication with her pregnancy, that she actually developed, meningitis during her pregnancy with me. So I guess I turned out okay, thank God, right? But that was she was out of work for some time, right? And so her disability insurance paid her because that was a complication that arose from the pregnancy, right? But that's not it's not going to cover you for like a normal pregnancy, like a short-term disability might or something like that, right? So this is different, okay? And then the last couple of things are the pre-existing conditions. So they're not asking you any of these, health history questions, right? They're not saying, hey, do you have, X, Y, or Z, like they would in a traditional thing, because the guaranteed standard issue application is so brief, right? And so what they do is they put this provision, they call it a 3 and 12 provision. So they essentially say, if there's any pre-existing condition that you have, which is active during the last 3 months. So I translate that into, if you have any sort of pre-existing conditions at all, assume that they're not going to cover you for the next 12 months. So for the next year, they're not going to cover you for that time. From the policy issue date for the first 12 months, assume that don't try to, ask for a claim on a pre-existing condition for that first 12 months. So they essentially, this is just to catch people that are actively like about to be disabled and want to get this contract. We're not asking the health questions, right? They get the contract and then the company be on the hook for that right out the gate. So think of this as a 12-month hurdle that people will have to jump before they get access to the coverage. So, but after that 12 months is up, regardless of whatever pre-existing condition you have, it's all fair game after that point. So even though they're excluding that stuff for the first 12 months, after that 12 months, it's completely fair game for any sort of disability that you might have. So really key point there. And then the last one is the mental health or nervous system, alcoholism, drug abuse. Pretty much any DSM related mental health condition falls into this category. And as you can imagine, there's a lot of fraud going on in this space where physicians are actually writing scripts for their partners that and saying, oh, they're depressed and can't work clinically anymore, and collecting benefit, and then they were going and working on faculty somewhere and collecting additional income. So there's a lot of fraudulent activity in the mental nervous space, and the disability insurance companies had no real recourse on this. And so because it's a physician script saying that, they had to follow their contract, so they really got taken advantage of this on that. And so, but they recognize that it's a thing. And so they did limit it to 24 months for the lifetime of the contract. So if you have a mental health related disability, they'll cover you for the first 2 years, no questions asked, outside of obviously having a physician, look at that for you. But the big thing is, past that point, you actually have to be institutionalized or hospitalized in order for them to continue paying that past that point, right? So that's something that is fair, but something that you got to make sure that you're aware of on that, okay? And then last other things, we do get some clients that are, maybe looking to reside outside of the US. And so that's something that is, something that you can reside outside of the US and they'll pay benefits out, if you're living outside of the US, but only for 12 months. And so if you're get disabled and you're living abroad, they'll pay you, they'll send you checks, abroad for 12 months. But then after that point, in order for you to continue getting your benefit all the way to age 65, if you're continually disabled, you got to come back to the States. So that's how they do it. They don't want to deal with all the currency exchange and all that. So, and then the last one that is key is that they can't cancel the policy on you, and they have to guarantee your rates all the way through. So they can't change your rates all the way through, which is really cool. So as long as you make your premium payments, your rate stays the same for the whole time you have the contract. And obviously, if you want to get more coverage in the future using that benefit increase rider, you can buy more coverage. And obviously that additional amount would be based off of whatever age you are at that time, but you still get all the discounts that you got originally, and you do everything. The only thing different is just that it's a little bit more expensive because you're older at that time. But your original rates that you got, when you first started this contract, those stay the same. So if you got 6,000 of coverage, and let's say it's, $200 per month for you, it will be $200 per month for the rest of your career if you never choose to increase this coverage. It will not go up one penny on you, which is really nice. So it gives us the ability, and as long as you make that premium payment, they can't cancel it on you. So that's kind of pretty much the long and short of the contract. So we'd love the opportunity to kind of break this down with you further and run some quotes if you have questions on this. But in short, we don't need to overcomplicate it. We need to make sure we have a true and occupation policy. We need to make sure that we know that this coverage is going to pay out if you do have some loss because of your job or your income. We got to have a backup plan. This is kind of the outlet until we get you to the point where we have, a nest egg built up that, we can, self-insure for that time and not have to lean on an insurance company. Because trust me, the best time that we can get you to do is when we get you to a point where we have enough that we can cancel these policies, because that means you're financially independent. So looking forward to that time, but feel free to reach out if other questions come up, and we'd be happy to serve you. Thanks so much.